Welcome everyone. My name is Caitlin Donnelly, managing partner of a fund called Avalanche VC. We invest pre-seed in companies that transform how people learn, earn, and own using technology. I'm one of the co-hosts of this virtual learning series with my friends ECMC, Education's Impact Fund. They're an evergreen fund of over $300 million investing across pre-seed, Series A, Series Bs, and beyond. And today we have a special guest, James Marciano. He is the founder and managing partner of Tuck Advisors. Tuck is a investment bank and financial advisor dedicated to the education and future of work sector and likes working with sort of small, more medium-sized companies as they begin to think about their exits. And so today we're going to learn from James about what you need to know as a founder or a CEO when you're looking to exit, and that it's never too early to know the options. So even if you're thinking of starting a company, just started a company, or just raised a pre-seed, the more knowledge that you're empowered with, the better off you will be when you get there. So welcome, James. We're so excited to have you. It'll be great to learn from you. Before we get to your presentation, I have one more housekeeping announcement, which is to say we want this presentation to be super interactive. If people have questions, please put them in the chat, come off mute. We want to hear them. We'd like to make sure that all your thoughts are being addressed. Please let us know what you're thinking. All right, James, over to you.
Thanks, Caitlin. So good to see you again. And I also want to invite everybody to put in the chat who they are, where they're from. If there are any specific questions they'd like to address during the presentation, I'll try to weave those in as best as I can. And there'll also be plenty of time at the end of this short presentation for questions. So looking forward to an interactive session, and I'm going to see if I can share a screen here. All right, Caitlin, that look okay? Great. As Caitlin said, it's never too early to know the options. I remember way back in the 90s when I had one of my first internet companies I was starting in New York. It was Christmas Eve, and I was working in the office. Somebody from San Francisco had flown in. We were in the education space. And he said, tongue-in-cheek, you're going to sell your company before you start it. And that's actually not bad advice. So yeah, never too early to know the options. We love to talk to people 2-3 years before they are thinking of selling. Why I'm doing this work. So I was a serial entrepreneur, and basically I'd hired investment bankers, M&A advisors to help me sell my companies. And I wasn't very satisfied with the work. I didn't think they understood me as an entrepreneur. I didn't feel like I was getting the A team. And so after I started 3 internet companies, 95, 2000, retired as an angel investor for about a dozen years, became an LP in some funds. And then we moved out of New York to raise our family in Bucks County, Pennsylvania. And I wanted to get back to building something. And I thought, let me try to build the type of M&A advisory firm that I wanted to hire and I couldn't find. The thesis was really that there are not enough good M&A advisory firms in the lower middle market to help entrepreneurs, especially first-time entrepreneurs who have not been through the process and really need help the most. There weren't a lot of firms using process and technology the way that I knew it could be used. I also wanted to do that with companies having a positive social impact. As Caitlin said, we're very focused on education. We also do some work in healthcare. Moving on, at a very basic level, there's 2 buyers for your company, strategic buyers and financial buyers. And it looks pretty different. For a financial buyer, if it's a private equity firm, for example, but just you're going to have angel investors, seed stage investors, venture capital firms, and then at some point you start making money, you found product market fit, and then maybe you raise additional capital from a growth firm, a private equity firm that you want to put fuel on the fire just so you grow more quickly. There's going to be financial buyers that do minority types of investments, but there's also going to be the majority transactions, and that's where we focus. We don't work with companies looking to raise capital. I did plenty of that back in the day for my own companies. With financial buyers, it's mostly going to be private equity firms, but there are any number of other financial buyers. There could be search funds or family offices. There's a whole host of different types of financial buyers. But if they're buying your company, we're thinking about it as a new platform or a net new platform. It's not an existing portfolio company where you're doing tuck-in acquisitions. We think of those as strategic buyers. Since this is an education-oriented group, right? I could say All Ventures, big venture capital firm, they might have a portfolio company that's looking to do acquisitions. That's different than if All Ventures was looking to buy a company, but of course they're more venture capital oriented. They're not really buying profitable businesses. But we, of course, would work with their portfolio companies if they're interested in doing tuck-in acquisitions. Strategic buyers, if you think about them, most of the time M&A is going to happen in we think one of these 6 cells, and it's really 5 of these cells. So this is what we call the M&A Matrix. And I just want to present it now because it's the framework that we think about M&A in. And most deals are going to happen because there's some overlap between customers and or products and services. So you can imagine, for example, if you had a tutoring business for high school students and somebody else had a consulting business to help them get into colleges. That would be the same customer. That would be high school students, or let's say parents of high school students. And then it would be an adjacent or complementary product. So you're doing tutoring, or let's say it's SAT test prep. That might be an even better example. And then these are people that are interested in having consultant handhold them through the application process to colleges. Those two companies might come together, and that would be cell 3. So again, it's just a way we think about M&A, and it's useful for us as we go out to market when we're selling a company to check in. So if we built a buyer list of 1,000 companies for you, we can check what cells they're in. Larger transactions will appear in more than one cell. So that's just something to think about. Smaller transactions might be just one cell, but if, I don't know, Google were buying Amazon or something, right, you can imagine how that might fall in all 6 cells. The one cell where M&A oftentimes isn't going to happen is cell 6, right? Because you have different customers and different products and services. I sell auto parts to auto parts stores, and you're selling tutoring to school districts, right? There's just not a lot of overlap there. So we think about this in M&A, and then
James, go back to that one cell where it's more than, it's not cell 6 or one of the other cells, like the majority of what you're pretty evenly distributed.
Yeah, we'll actually be publishing a white paper in the next couple of weeks. We went back over the last few years and looked at 100 education deals to see where the action was, and most of it is in cell 3. Yeah, so I'll be sure to share that out to you and Mindy, and you can share it with the group. You can see how there's going to be a lot of action in cell 3, and so oftentimes we automatically go there. But then it's important to realize, hey, are we paying enough attention to cell 2 or cell 4? Maybe we should be thinking more outside the box, and maybe it's a different customer base that we hadn't been thinking about. Maybe we've been selling direct to parents for tutoring, but we could be selling to school districts and selling stuff to school districts, for example, in an adjacent product or service, right? That would be cell 4. We do see most of the action in cell 3.
Where do founders get the most negotiating power?
Geez, that's a great question. I'll have to come back to you later on that, Caitlin, because the most negotiating power founders have is when they run an auction process and they have more than one bidder, and they're able to really escalate it. A lot of it's around value creation, and that can happen in any cell. So we're showing a potential buyer how you can help them. I remember one deal in the LSAT space where it was test prep for LSAT. We were able to show the private equity backer, based on their portfolio companies' current mix of clients, that if they even got 5% of their current client base to take this LSAT course, they'd have X millions of dollars. And so that's where the hard work comes in, trying to figure out the value creation based on some assumptions around potential buyers. In terms of whether one of these cells or not creates more leverage, I don't know, but it's a great question.
One thing you mentioned that I think is helpful to make clear is how many of your strategic buyers, especially in EdTech, are actually backed by financial buyers? Does that influence the dynamics? Are you ultimately making a case to a financial buyer?
Yeah, we work on the sell side and the buy side. On the buy side, for example, these are typically these are operating companies in education, say professional education, that are PE backed. And so that's typically where we're seeing our work with tuck-in acquisitions. But we've also spoken to lots of companies that were not PE backed, that we were doing work for tuck-in acquisitions as well. It really depends where you are in your life cycle. PE backer is the one that's going to stroke the checks for doing these acquisitions, or if somehow you've been able to grow more organically or just through venture capital and you've gotten to profitability and now you're going to acquire companies. There's a lot of companies now that haven't been able to raise their next round of capital, and they're looking for homes. And oftentimes that can happen in a private stock transaction, private stock for private stock. And one thing I want to say is that no matter what the size of your company, even if you're a pretty small company, thinking about M&A is always a good idea. You might not think, just because you're $1 million in revenue, you might think, hey, I'm not big enough to acquire another company. But that's not true, especially when there are lots of companies looking for a home and might have valuable IP or clients. It's never too early to start thinking about your own exit, but it's also never too early really to start thinking about possibly doing your own acquisitions.
Super helpful.
So what we did was we took this framework and we said, let's go ahead and create the first ever custom GPT, which we launched February 1st, and let's train it on what the M&A Matrix is. So for those of you who have even the free version of ChatGPT, you can go on to the M&A Matrix and you can play what if games. So there'll be two buttons. One is what is the M&A Matrix, and then the other one is analyze a deal. If you click on analyze a deal, you can put in any deal that's happened already, and it'll give you its analysis of that deal. It'll start to talk about the customers for each of the two companies. It'll talk about the products and services for each of these companies, the synergies and potential risks. It's just a fun kind of, hey, why did this transaction take place? But then you can also play what if games. Let's say you've been approached by a UFO, unsolicited flattering offer, and you want to see why the two of you would make a good combination. You can play that what if game and analyze a deal within the M&A Matrix. And it's really fun to know that there are people around the world using this now, and we get great feedback on it all the time. Like any kind of AI, it can have its good days and bad days. Mostly it has good days, but sometimes it doesn't give you as much information as it should. But generally speaking, it can be pretty compelling. We have this as the outward-facing ChatGPT, but then behind the wall for us and for our team members, we have much more refined versions where we train it on every client of ours, whether it's a buy-side or sell-side client, and then that way it can spit out even more refined analyses like this and what we call positioning statements. It's really cool. We're really proud of it. First people ever to launch this. My background's in technology, and I encourage any of you to try it if you'd like. So for those of you who are not familiar with the sell-side process, we'll just go through it on this slide. There's essentially three phases. Phase one is creating the assets, and the assets come in two flavors. One is the marketing assets, the other is the buyer list. And the marketing assets are twofold. One is the CIM, or confidential information memorandum. You can think about that as like a 35-page document. These used to be documents, and then at some point along the way, most M&A banks transitioned to slide decks. I don't think slide decks work very well unless you're actually presenting to an audience like we are today. So we still do it the old-fashioned way, write up a document. And then from that 35-page document, we distill down to one teaser or one-page overview, which could be an offering memorandum or a blind offering memorandum. So we get those two things done, and then we build the buyer list. One of the reasons I came out of retirement to do this was because when I hired Silicon Valley investment bankers, I remember the first one I hired to sell my second company, they took my upfront money and literally introduced me to 3 companies. That was it. I've had conversations with some of the largest M&A firms in the world, and they'll brag about how exhaustive their buyer lists are and how they have offices around the world and these huge CRMs. I've asked, how many people do you go out to? And they're like, oh, we go out to 30 or 35 parties. We do orders of magnitude above that. A typical project will go out to 1,000 potential buyers around the world. Why is that? If you're selling a $1 billion company, the likely buyers are going to be pretty obvious. If you're selling a $5 million revenue business or $10 million revenue business, it's likely that no one's ever heard of you. We just finished a project. It should close 12/31, but we went out to 1,267 buyers around the world. We had 125 NDAs signed. We had 10 indications of interest. We had 5 people. We had the management presentations, and then we had 3 LOIs. That's the kind of effort it takes to get a really good bid for a company. Anyway, that's phase one, creating the assets. Phase two is reaching out to the buyers. You reach out to the buyers with a one-page teaser. If they're interested, they execute an NDA. They get access to the CIM and then the data room. We also have something we call CIM FAQs. So as people ask questions, right? If they get the CIM, they read it, but there's still questions they have, right? We didn't answer every single possible thing in the CIM. We can possibly think of every question somebody's going to ask. And so we have an evergreen document that anyone who's executed the NDA has access to. That's really helpful so that we don't have to answer the same question twice, and also creates more of a sense of competition, right? Because you see other people asking smart questions. And then there's deadlines here. So nothing happens without a deadline. There's an indication of interest deadline. You can think of indications of interest as being written with crayons. So broadly speaking, what's a range of what you might pay for this asset? And then a handful of other questions like, do you need board approval? Or do you have the capital? Do you need to get capital for this transaction? A couple of questions just to see if they're in the ballpark. And we talk to our clients about what makes sense and invite a certain number of those folks to management presentations. Those management presentations are typically in person. They might be hybrid, might be some team members in person from the buyer side and some over Zoom. We had a management presentation recently where some people showed up the management presentation in Philadelphia, but there were other people in England, right, that were just zooming in because they didn't want to fly over. A couple weeks after management presentations, and that's one-on-one, that's you with prospective buyer, and we do 2 of those a day. So we'll do one at 9:30 in the morning, and we'll do the second one at 2 o'clock, and we'll do a couple of days of that. Sometimes we'll do some on the East Coast, some on the West Coast, depends where buyers are. 2 weeks after that, we have letters of intent that are due. If indications of interest were written with crayon, LOIs are written with sharpened pencils. So it's not a range of value, it's precisely how much are you willing to pay? Is there any earnout component? How long do you expect to take to close this transaction? What's your due diligence request going to be, et cetera? At that point, we sit down with our client, and it's very rarely apples to apples. Oftentimes these look like apples to pears, sometimes apples to pears to walnuts. So you try to figure out what's the most important thing to the owner, founder, and their investors. Hopefully those stakeholders are all on the same page. If they're not, that's an issue. We try to get that stuff out of the way before we even start a process. We try to make sure that we find the right LOI, we negotiate it. Once you sign it, you'll enter into an exclusivity period where neither you nor I can talk to anybody else. We can't be shopping around to other people because the buyer is going to spend real time, real money on doing due diligence around legal, commercial, financial. And so they want to make sure that they can get through that process without some other bidder jumping in front. And then that's phase 3. So trying to get due diligence done and the purchase agreement done, whether it be a stock deal or an asset deal. It's important to think about which one's going to be better before you get to the LOI phase. And then the purchase agreement signed and the transaction closes. In terms of timing, you can roughly think of each of these as about a 3-month effort. We've had deals close faster than that. We've certainly had deals extend closer to a year. But key is trying to time kills deals, and you want to move as quickly as possible. Caitlin,
what happens if you don't have any LOI?
We've never had that happen, unfortunately. At that point, you take a pause. We've had deals that didn't close. I've never had a client say, we didn't learn a ton from this process. There's an example a couple pages from now where we're going to talk about that. But basically, you get a lot of really good feedback from the market, and you can use that information to move forward, improve the business, and maybe in the next 12 to 18 months, go back out and try again. And we have an example of that right now, where we had a client 2.5 years ago that we were 3 days away from close. And I'm probably the only investment banker in the world that would say this, but I told him, I said, I think this deal stinks. I'm like, we'd love our big fee and paycheck in 3 days, but I just don't like this for you guys. If you can do what you say you're going to do over the next 24 months, then I think you ought to stick your head down and keep working, and then we should go back out to market. And so that's what they did, and now we're taking them back out in January, and we're in a much stronger position. There's a lot of learnings that go on through this process. There is also a ton of effort and time, and we try to protect our clients' time as much as possible. In phase 1, we're going to need your help making sure we get the assets right. And then phase 2, obviously, as you're meeting with clients and reviewing IOIs and LOIs, that's going to be work. Phase 3 is all hands on deck. So just some things to remember, as I mentioned, time kills deals. And why is that? It's just because stuff happens. I remember we were taking a deal out to market in March of 2020, and the pandemic happened, and our clients sold things to hospitals. It couldn't have been worse timing. We were trying to close a deal in the education space 1.5 years ago, and interest rates kept going up. 5 years ago, I was trying to close a deal, and 3 weeks before close, our client lost their number one customer, which represented 18% of their business. Like, stuff just happens. So you really want to be as prepared as possible going into these transactions and get through them as quickly as possible. Number 2 is keep running your business. You got to keep running your business because we don't want the business to slow down, right? That's the worst thing that can happen, is for numbers to start to deteriorate. So you're really doing 2 jobs. You're trying to sell your company and work with your advisor, but you're also trying to run your business. Speaking of advisors, you need to be really completely honest with your advisors. We had a situation 8 years ago. The guy had a really bad quarter and didn't tell us. He buried it in the data room, and the buyer, who was from Korea, saw it and came to me and said, hey, what's going on? I had no idea. Now, if the client had come to us, we could have at least tried to nuance it. But at that point, it was too late. We wound up firing the client because I can't help you if you're not going to be honest with me. I can't protect you if you're not going to be honest with me. It's the same thing I tell my kids. Always be honest with your advisors. Be mindful of your top customers, suppliers, and competitors. This is always an issue, especially with companies that are more B2B. Sometimes your customers could maybe potentially be your best acquirer, right? Half of all M&A happens because of an existing strategic partnership, because they understand how important you are to their ecosystem. There are better ways to phrase that than others. Like, we might have you go to your customers and say, hey, I want to let you know that we've decided to take our company to market. We know you're a really important customer of ours. We just wanted to see if you had any concerns. And so invite and let them know that they're important. Tell them ahead of time before you start the process. Essentially invite them into the process, right? They're going to know, hey, these guys are going out to market. Maybe I can jump in and be a part of this. But it is important to be really thoughtful about how this is communicated, because it could get back to them and we can say, if this gets to them and you didn't tell them, is that going to be a problem or not? So we always want to think about that really carefully. That's a pretty in-depth conversation we have with our clients. To the extent possible, include your team. There's a lot of work to do throughout, right? If you're the only person that's going to be able to assist your M&A advisor with pulling the financials, for example, or pulling contracts or looking at IP, it's going to fall disproportionately on your shoulders. Normally what happens is there's a staggered approach where the CEO will bring on key members of the management team, keep it close at the beginning. As we go further along and it becomes more evident that this is probably going to close, they might invite more people, and then until the end when the transaction closes and everybody knows. To the extent possible, you want to include your team. It's always helpful. Last 2 points, negotiate the LOI completely. You don't want to have a situation where you left things to chance or open to interpretation for the lawyers to figure out. Oftentimes, the buyer is pushing to get the LOI signed just to get it under exclusivity. But as a sell-side advisor, I always want to make sure that everything is really ironed out ahead of time, so that when we sign it, the lawyers really know what they need to do with the document to translate it into a stock purchase agreement or asset purchase agreement. I would recommend taking the extra week or two to be really clear about what the intent is in the LOI. So there's no guesswork. And then the last thing is keep your eyes on the prize. The phase 3 can get heated even after the LOI is signed. There'll be discrepancies about how buyers view things. There's always asymmetric information. Each party should use that to their advantage. But you really want to try to keep your cool, and you want to try to keep your eyes on the prize. If you really want this transaction to happen, check your ego at the door, let go of things that ultimately aren't that important. Realize that everything in life is risk. As entrepreneurs, you know that, right? You've taken the risk of starting your own company. And so just know that there comes a lot of risk in running this process as well as closing the transaction. Make sure you work closely with your advisor to try to mitigate the risks as much as possible and be as comfortable as you can.
I think this last point, 2 years ago, we exited the company that I co-founded to private equity. And I definitely feel like it's a very emotional process. You spent 10 years building this baby and all of a sudden you're handing it over to someone. And there's a huge range of emotion in that. Working with a banker or a financial advisor can be the game changer because they're not emotional about the decision. What macroeconomic factors should founders think about when thinking about an exit? Does that come into consideration for when they should run this type of process?
Yeah, for sure. The last 18 months have been really trying, especially because of the interest rate environment. But I also think there's other macro reasons why it's been a problem. Clearly, valuations have come down dramatically. I could spend hours talking about that, and too much capital, not enough TAM. But I would say, regardless of your political leanings, Trump getting elected certainly is going to be helpful to M&A. You saw Goldman Sachs was up 8% in trading in the morning right after the election. Interest rates were starting to come down, which again matters, I think, more to companies that are going to sell to private equity, or private equity portfolio companies. Light was starting to peek out from the clouds a little bit. And I think now with this election, I think things are really going to be much, much better in 25 than they were in 24. From a macro perspective, we're encouraging our clients or prospective clients to start thinking about an exit for 25.
Mm-hmm. Great. Well, that's good news for everyone looking to exit.
I was having a conversation earlier today with somebody about this who's thinking about going out for a capital raise in 25. I think capital raising is still a little bit tough, but I think the M&A markets are opening up ahead of that. You just reminded me of one point I wanted to make, which is you can use your advisors, you can throw them under the bus. which can be really helpful during a process. So if there's something you as the seller, as the owner, really are just like really picayune about, hey, I really want this, right? You can use us to say, hey, look, we as the bankers are insisting that this rep and warranty are in here, or the reps and warranties don't extend beyond 12 months or whatever, because there's an earn-out or you're going to be going with the sale in any way, shape, or form. You want to maintain a really good relationship with the buyers. And so feel free to throw your bankers under the bus. And understand that's a strategy.
Yeah.
All right.
Good point.
So just 2 slides here, one on financials and one on your team. Being on an accrual basis, even if your business doesn't really matter if it's on a cash or accrual basis, the buyer is most likely to be on an accrual basis. And again, going back to time kills deals, number one axiom of M&A. If the buyer has to go through your accounts and start to figure out, hey, how do we change this new accrual and figure out what the deferred revenue is, your liabilities are, that's going to take time. So just get on accrual basis. If you haven't already started your company, QSPS election is really good, so you don't have to pay taxes after 5 years. P&L statements.
Can you say more about this? I find that many founders don't even know what QSPS is.
That's like the greatest secret ever. It's qualified small business.
Election or, yeah.
Somebody knows, somebody will chat it. But basically it's a way to set up the company as a C Corp, as long as it's worth less than, I think, $50 million at start, you can, or when you do the election, you can set yourself up as a C Corp, and then when you sell, you don't pay any taxes.
$1 million, right?
Yeah, there's some limit, but it's definitely worth doing. I personally have never taken advantage.
Again, it's qualified small business.
So great. I won't forget that. Talk to your lawyer about it. Google it. Find somebody who knows how to help you set that up. We've definitely worked with companies. I was talking to a potential client a couple weeks ago, and his full QSB essentially vests in February. The nice thing is, if we're going to take him to market, by the time we close, he's fully vested. Even if you're not fully vested, you might be able to take advantage of a certain proportion of it. I'm sure there's other rules around it in terms of, ownership, but for anybody who's a LP in a fund, they're always talking about taking advantage of QSBS and investing at a certain time. So, Caitlin, do you have any experience with this in terms of your LPs?
Yeah, definitely. We think about it a lot because there's a debate about whether safes, if you're an investor, you have to wait 5 years, at least a 5-year hold period, and get the QSBS. There's a debate about whether safe notes count as starting the clock or if you have to wait for a priced round. And angels particularly, some of them really are interested in investing for the QSBS. If you have a more cash generative business, it doesn't look like a true venture, it can also be a selling point for founders to raise capital from high net worth individuals. If they're like, okay, you can we're going to price the round, you'll get some QSBS, and then our plan is to exit after 5 years and set you up for success. So most savvy high net worth individuals who angel invest will think about that as a big benefit.
If you haven't started your company yet and you want to go set up shop in Puerto Rico, that's a fantastic tax haven. I think you pay 0%, or I think maybe up to 4%, somebody was telling me. Okay, P&L statements, it's great to have for a couple of years. Up to 5 years would be ideal. 3 years certainly would be good. Forecast for next year, forecast for the rest of this year and then next year, right? You're going to want to stand behind any forecast in case there is an earnout. Those are your numbers. Buyers are going to hold you to them. We always caution clients to be realistic about the forecast. If anything, I'd want you to actually undershoot it just a little bit, but you better not come up short during the due diligence process, right? You always want to be making sure that you hit the numbers or go a little bit above. I was talking to one of our clients yesterday in the education space, and he was saying that we had taken him out to market about 7 weeks ago, and just before we went out to market, the day before, he's like, oh, I just don't know what October is going to look like. Can we lower the numbers just a little bit? It actually took a little bit of time, a couple hours, to go back and wherever we had the numbers, we changed the forecast just a little bit, 5% down, just to be super safe. And then what do you know, he crushes it in October. We would have been totally fine, but it's better to be safe than sorry. And then a balance sheet ready to go. Make sure your cap table is up to date. People ask about that. If you've raised a ton of money, by the way, you need to make sure you position it in the right way. We have a client right now that is under LOI, and they'd raised tens of millions of dollars. And when investors see that, they get nervous. They're like, gee, is that the expectation? As your advisor, we let the client know that the client has reasonable expectations. They understand that the value of the company today doesn't really have any bearing on how much money was invested into the business. Sometimes it can be a good reflection, for example, of how good the technology is. 80% of the money was spent on technology, and if you're going to have to replicate that, that's real dollars. So important to have the cap table and be aware of how it impacts how people perceive the business. If you're at a point in your business and can do a quality of earnings, that's basically an outside firm taking a look at your financials, looking at the quality of your revenue, your costs. It really helps to control the narrative with a buyer, because buyers are always going to hire a firm to do the Q of E. But if we do one first, even if it winds up being stale by a couple of months, at least direct the narrative and say, the reason this looks like this is because of X. This was a strategy that the seller wanted to employ, the founder wanted to employ, and that's why we're doing this. When you think about this number over here, this is how we think about it. There are firms, nationally recognized firms that do quality of earnings, smaller firms, but if you're going to do it, I would spend the money. I had a breakfast meeting this morning with somebody that does this, with a pretty, like a mid-sized firm that does this, and the Q of E is going to be somewhere in the $50,000 to $80,000 range. If you're going to have a transaction that's millions of dollars, it's worth doing that Q of E. And in fact, we're insisting that clients of any size that we're taking on are going to do a Q of E first. Because why? Because time kills deals, and having this done is going to really help during diligence. Last thing people always...
Yeah, and that's even if you do audits every year, you still have to do a Q of E.
Yep. And a lot of companies don't have audits, and that's okay too, as long as they're reviewed. But yeah, for sure, if you can have a Q of E done once a year, it's really nice. When I talked to one of the biggest firms in the country that does this work, and I just asked them, hey, what's the percentage of QEs that you're doing for the sellers versus the buyers? And they said now it's almost 50-50. So more and more buyers are expecting that sellers are going to have a Q of E done. Last point here is revenue. People always ask me, hey, what's more important? I have an early stage business. Should I be focused on revenue growth or profit? In general, it's more important for earlier stage companies to be growing as quickly as possible. For later stage companies, if you're going to get valued on multiple EBITDA, you want to have more profit. If you're going to go out to market in a year or two from now, you should really be thoughtful about any investments you're going to make in the business. $1 million to upgrade your technology because you've got some tech debt, and you're not going to see the results of that for 2 years from now, and you're going to sell next year, right? You're going to wind up hurting yourself in the process. As you get closer to an exit strategy, you just want to make sure that any investments you make are going to be worth it. Having said that, I always tell sell-side clients that they should run their business as if they're not going to sell, because you never know what's going to happen. So you don't want to be putting off important decisions, hiring decisions, for example, if it's going to really impact your business. Balance those two things and be thoughtful about them. The last slide here around planning for an exit is people. Establish a board of directors with quarterly meetings, even if it's only a formality. Make sure you have notes for those things, and you can go back and you can paper them over if you don't, but it's just helpful to have that. Make sure employees and contractors are signing NDAs and assignability of IP work agreements. I can't tell you how often we get into a situation in due diligence in phase 3 and these things haven't been done yet. And then you're stuck because maybe you don't have a whole lot of leverage and you're trying to get people to sign stuff. Always keep your organization chart current, just like your cap table. Have a team of advisors ready to act. We talk about unsolicited flattering offers a lot, UFOs. The phone rings one day or you get an inbound email and it's somebody, hey, we'd like to buy your company. And if you don't have these things in place, if you don't have current org chart, you don't have your NDAs and all these other things, it's going to hurt. And if you don't have your advisors in place, it's going to hurt too, right? You're going to have to rush around and quickly find an M&A advisor, an M&A lawyer, who, by the way, is like super, super important, right? Don't hire just any lawyer. You got to hire somebody who knows M&A law because it's its own thing, and they have to understand what's market. M&A tax advisors, which can be really hard to find, people that really understand the impact that the transaction is going to have, especially if the PE firms want to do a 388 H10B election. That's going to impact things if it's going to be an asset or a stock deal. So you want to find out at the end of this deal what you're going to take home. That's really important. And then somebody who understands how you can do a net working capital peg. It just gives me a headache every time. There are people that are really good at figuring that out. So you make sure that you're not leaving money on the table. A team of advisors ready to act, and how the business is going to run post-transaction. If, for example, that you really want to just drop the keys at the door and walk away, then you better have a strong second, right? You better have a strong COO. It's always helpful to whoever your M&A advisor is to have optionality. So one of our clients right now is saying, hey, look, let the buyer know I can drop the keys at the door, or I can stick around for a transition period of 90 days to make sure they're comfortable with where everything is, or I'm happy to stay for a year. Having that flexibility is going to really be helpful to you and to your advisor and be able to work with the best buyer. Just a few things there. I know we're running out of time. I do have a case study, and then it's just questions. Caitlin, just stop here and see if there's any questions, and then if we have time, we can do the case study.
Let's just do a check and ask and open it up and see if there are any questions from the group. Does anyone have any questions for James? comments, things that are on their mind. I'm not seeing anything so far.
All right. I'll do this case study. This was a buy-side target. We do sell-side and buy-side work. This is a company in professional education for IT professionals, so continuing education, certification, upskilling, that sort of thing. And they've been a target for a buy-side client, and as our client did due diligence, there were some things that they didn't like. For example, there was key man risk. The founder of the company and did all the videos, the async videos for the training. If he gets hit by the proverbial bus, that's going to be a problem. So there were a number of things that they didn't like and said, hey, this is the reason we're walking away. Very thoughtful founder. He really took that to heart because he had spent quite a bit of time working with the potential buyer. And he went ahead and made these changes that had been causing the buyer angst. Months later, he called me, and I really love this guy. He's one of the sharpest entrepreneurs I'd ever met. We had kept in touch every couple months. And he called me one day and said, hey, James, we've got 3 UFOs, and we'd love for your help on the sell side. We'd love for you to represent us. So we went and we took those 3 UFOs. We said, hey, we're here to, this CEO's hired us to try to get a deal done if there is a deal to get done. He doesn't want to be distracted. He wants to keep building his business. So he wants to get a deal done. Otherwise, he's going to keep his head down and keep building. We were able to come in and say, hey, you have 2 weeks to submit LOIs. You guys have already exchanged a bunch of information. Here's the bid letter, a process letter in terms of what we're looking for. One bid was not really competitive. The other 2 were very close to each other. When I talked about apples and oranges, they were kind of apples and oranges, but they were both about the same. Say, for sake of argument, they were both $20 million. But there were some small differences between the 2 of them. One of them being ability to close, like certainty of close. That might be the most important thing as you look through the offers. How sure are you that this buyer is going to be able to close? Have they done deals in the past? How many of these deals have they done? Do they need to get outside capital to do the deal? Do they need board approvals? Is it contingent on anything else? Are they going public and we have to wait till they go public, right? Like all these things around certainty of close are super important. And the other part of the equation, and actually this is the thing I was doing at 4:30 in the morning, was literally writing this equation up because it just dawned on me. The other part is the deal itself, right? How much money is up front and how much is at risk? The at-risk portion is how much money is part of an earnout, how much money is part of a seller's note, how much money is in escrow because of reps and warranties. You really have to multiply those 2 together to get the highest expected value. You want to sign the LOI with the highest expected value. We went with an offer that was a little bit more weighted toward earnout, but we all felt really good that he was going to hit the earnout, despite what you may have heard. If the earnout is constructed properly, and there's definitely ways to do it, devil's in the details. I personally, with the companies I've started and sold, I've always done well on earnouts. My clients have all done well on earnouts. It takes somebody who knows what they're doing and really understands what's important. So yeah, we took something with a little bit more earnout, but we were really sure of the buyer and the certainty of close, and we wound up closing really quickly. So yeah, one case study, but wanted to share that with you, and we can have questions now. Yeah. This is my contact info, whatever everybody's interested, but I'll stop sharing and we can go from there.
Well, thanks, James. That was super helpful and incredibly informative. When should founders reach out to you, and when do you advise?
So for sure, if you've gotten a UFO, right? If you've got an unsolicited flattering offer, somebody's flown in and starting to have serious conversations, that's oftentimes when people call us. It's not that it's too late. It's the perfect time to call us, but it would have been nice to have known that person beforehand, like we did with that case study that I just shared. And so I would say it's never really too early. I would say if you're still trying to figure out product market fit, if you're raising seed, maybe a little bit too early. We love to meet people. We love to take phone calls, but there's only so many hours in the day. But yeah, if you want to exit in the next 2 or 3 years, or that's likely, then for sure, happy to have a conversation and talk about what you can be doing today to optimize your exit.
Got it. Any other questions from the group, from the attendees? No questions. Everyone's like very clear, easy.
I've done such a good job, Caitlin, that nobody has any questions. Glad we recorded this, right? Now, no one has to ever do an M&A talk again. We can just reference this one.
I do feel like M&As, when people apply for their first mortgage, notoriously financial literacy education is, people are like, you should teach mortgages in high school. No one cares about a mortgage until they're looking at a house hoping to buy. And I think that's probably what it's like educating people on M&A, like until you get that first offer, no one wants to think about it until they truly need it, as Ann just said in the chat.
That's exactly right. There needs to be a reason to pay attention. Everyone's so busy all the time. I understand that, but we do get people who are older that are looking toward retirement, right? And they're pretty set, like, I want to retire in 3 years. What do I need to do? It's always good, and I talk about it as a fiduciary duty. If you get an offer, you should probably investigate it. It can be really helpful to have an advisor playing that role. I'll give you one example. We had a client that had 2 UFOs, and he went to the first UFO, and the UFO asked him, well, how much do you want to sell your company? And he said $7.5 million. And lo and behold, the LOI came back at $7.5 million. I was like, don't do that again. Let us handle the next one. So he engaged us. We went to the next one. He said, hey, LOIs are due next Friday. Oh, well, wait a minute. Like, we still have a lot more questions. I said, no, you guys have been talking for months. We already have a bid that clears the hurdle that we're willing to take. So next Friday, despite them saying, no, they showed up next Friday with a bid for 17.8 million, right? Like, completely different. Now, was that me? That's not me, right? That's just the process, right? That's just saying, hey, we're running an auction process here and we need your bid. Look, I would have been happy to stay retired or done something else more fun, because this is fun, but it's a heck of a lot of work. I just didn't see anybody who was willing to do the hard work. I couldn't find them, and so that's why we do this. I think it's important to think about it, be aware, be prepared. The best outcome has different meanings for different people. You just want to make sure you share that with your investors and with your advisors, and hopefully you get something great, and it's a good process. But it's a lot of work, and you should be prepared.
One last question. You mentioned at the very beginning of your presentation that small and younger companies can buy other companies as well. Yeah. Do you have a good example of when that makes sense and how quickly the process is? Like, given the expense, you're probably not doing qualified earnings, maybe you are. With all the transaction costs involved, is there a threshold for when it just doesn't make sense? Or how do you think? What advice do you give?
Yeah, I mean, so in that case, you're always going to want to do an asset deal, because you're not want to deal with the overhang liabilities of a stock deal, and you might cherry pick the IP. There's outside the education space, there's Paratherapeutics, right, which was this huge unicorn, $1 billion plus company, and then it all fell apart, and the original founder bought the IP back for a couple $1 million or something, and had $1 billion valuation. So you can cherry pick the assets and do it that way, and you're going to really limit the amount of exposure you have to any pre-existing liabilities, and so it's going to be a much easier, cleaner deal to get that done. I'd say if you find something where there's IP or maybe there's customers, sometimes you can do a deal where, hey, you know what, we're going to pay you 50 cents on the dollar for the customer contracts. If they renew next year, we'll pay you 25 cents or whatever. So you can get creative around just buying customers. That's another way to do it. And then people throw around this idea of acqui-hire, but I don't really see it so much in the work that we do. It's more around some sort of IP or customers.
Got it. James, thank you so much for being with us. This was an incredibly informative presentation, and we are going to put it online, put it out on the newsletter, and get the clips out to our large audience. I'm sure that this will be able to, you may have seeded some M&A discussions that might not have happened otherwise. So much appreciate your time, and thanks everyone for tuning in.
Thanks everybody. My pleasure.